What if the global financial system is slowly shifting back toward gold without officially announcing it? What if central banks are quietly preparing for a world where gold becomes the main reserve asset again, while currencies lose strength? These changes may not look dramatic today, but powerful structural movements are already happening behind the scenes. Welcome to Gold Silver Scope, where we break down gold and silver markets with clear analysis and long-term perspective. Many experts believe the world is moving toward a system where currencies are not immediately redeemable in gold, but they are increasingly backed by gold as a primary reserve asset. This means central banks around the world may hold more gold and reduce their reliance on holding large amounts of dollars. If this trend continues, gold demand from governments and financial institutions will rise significantly. When central banks increase their gold reserves, it naturally pushes gold prices higher over time. At the same time, reduced demand for dollars as reserve holdings can weaken the dollar's value. If the dollar weakens, imported goods become more expensive, and domestic price pressure increases. That combination can lead to higher long-term interest rates and rising consumer prices. Some people believe technology and artificial intelligence could change everything by increasing productivity and economic growth. AI may improve efficiency and create new industries. However, these improvements will not benefit only one country. They will spread globally. So even if productivity rises, it will not automatically protect one currency or one economy from structural financial pressure. Before any major technological transformation fully impacts the system, economies must first deal with existing problems. Many countries are facing high debt levels and growing fiscal deficits. When debt becomes too large compared to economic output, governments often struggle to maintain financial stability. If confidence weakens, investors start demanding higher interest rates to compensate for risk. This creates pressure on sovereign debt markets and currencies. A debt crisis combined with currency weakness can trigger serious financial instability. That is why many investors and institutions are watching gold closely. Gold acts as protection against currency devaluation and financial uncertainty. At the same time, something interesting is happening in the digital and crypto space. Many companies are now approaching the idea of tokenizing gold. They want to create digital tokens that represent real physical gold stored in vaults. This trend is growing because investors want the convenience of digital assets combined with the stability of real gold. Tokenizing gold is different from creating tokens backed by nothing. If a token represents 1 ounce of gold, then the company must actually hold that gold in reserve. That creates real cost because physical gold must be purchased and stored. The profit margin in such a business is usually small because it is backed by real value instead of speculation. Some digital assets became popular because they were created with minimal cost but sold at high prices. Tokenized gold cannot operate the same way because it requires actual metal support. However, it provides transparency and convenience for investors who want digital access to gold ownership. Many people compare gold tokens with cryptocurrencies and argue which one is better. Some believe digital currencies like Bitcoin function as digital gold. Others disagree and say Bitcoin is highly volatile and does not behave like a stable store of value. Gold, on the other hand, has thousands of years of monetary history and proven stability. In modern financial systems, dollars are widely used as a medium of exchange. People receive salaries in dollars, pay bills in dollars, and conduct daily transactions using dollars. However, most people do not treat dollars as long-term savings because they understand that inflation reduces purchasing power over time. Instead, they convert dollars into assets like real estate, stocks, or precious metals. Gold historically served as both a store of value and a monetary anchor. Before modern banking systems, gold supported currencies and trade. Even after technological advancement and industrial growth, gold remained part of the financial foundation. The Industrial Revolution did not eliminate gold from the monetary system. Instead, gold helped support economic expansion during that period. Now we are moving into a digital era with advanced computing, online finance, and global connectivity. Some people assume digital transformation means physical assets become outdated. But just like people still need real food and real housing in a digital world, economies still need tangible value backing their financial systems. That is why the discussion around gold returning as a key reserve asset is gaining attention. Central banks appear to be increasing gold purchases while reducing exposure to certain currencies. This behavior suggests confidence in gold as long-term protection against uncertainty. The broader implication is clear. If gold demand from governments and institutions continues rising while currency pressure increases, gold prices may move significantly higher over time. At the same time, currencies that lose reserve support may face downward pressure. These changes do not happen overnight. They unfold gradually through financial flows, policy adjustments, and market reactions. Investors who understand this shift early can position themselves strategically before mainstream awareness fully adjusts. The global system is not officially announcing a gold standard return, but actions from central banks and market participants show that gold is regaining importance in the financial structure. As the global financial system evolves, one of the biggest debates is about the role of gold in modern markets. Many people question whether gold still matters in a digital economy. But when you look at central bank behavior and market trends, it becomes clear that gold is not losing importance. It is gaining strategic value. Central banks around the world are increasing their gold reserves. They are not doing this randomly. They reduce exposure to certain currencies and increase holdings of physical gold, because gold provides stability during economic uncertainty. Unlike paper currencies, gold cannot be printed. Its supply grows slowly and predictably, which makes it attractive as a reserve asset. If foreign central banks decide to hold more gold instead of dollars, the demand for gold increases while demand for dollars decreases. That shift naturally pushes gold prices higher over time. At the same time, reduced global demand for dollars as reserves can weaken the dollar's long-term strength. When the dollar weakens, several effects follow. Import prices rise because foreign goods become more expensive in dollar terms. Energy and commodity prices may increase. Long-term interest rates can move higher as investors demand more compensation for inflation risk and currency instability. This combination creates pressure on consumer prices and government borrowing costs. Countries with high debt levels feel the impact more strongly, because refinancing debt becomes more expensive when interest rates rise. Over time, this can develop into a sovereign debt challenge combined with currency instability. Another major trend in financial markets is the rapid growth of gold tokenization. Technology companies and crypto platforms are launching digital tokens backed by physical gold. The idea is simple: combine blockchain efficiency with real gold ownership. However, tokenizing gold is not the same as creating speculative digital assets without backing. If a token represents 1 ounce of gold, then the company must hold that ounce securely in storage. That means capital is required to purchase the metal first. Profit margins are smaller because value is backed by physical assets instead of speculation. Many businesses entered the digital token market hoping to generate large profits with minimal cost. That model works when tokens represent nothing tangible. But when tokens represent real gold, transparency and storage requirements limit extreme profit expansion. Still, the product is powerful because it offers digital convenience with real asset backing. Some people compare gold tokens with cryptocurrencies and argue that digital currencies can replace gold. But the key difference lies in volatility and trust. Cryptocurrencies often experience large price swings, and depend heavily on market sentiment. Gold has maintained purchasing power across centuries and economic cycles. Gold functions differently from digital payment systems. In modern life, people use dollars for transactions because payments must be fast and practical. Dollars work well as a medium of exchange, but not as a long-term store of value. Most individuals spend or invest dollars rather than saving them for decades. Gold historically served as money because it combined durability, scarcity, and universal acceptance. Even during technological progress, gold remained relevant. During the Industrial Revolution, society transformed with machines, electricity, transportation, and new infrastructure, yet gold still supported the monetary system. The transition from an industrial age to a digital age does not eliminate the need for stable monetary foundations. Technology improves communication and efficiency, but it does not automatically create financial stability. Economic systems still require assets that protect value during uncertainty. Currently, many observers see signs that the global system is adjusting. Central banks are increasing gold holdings. Investors are exploring gold-backed digital solutions. Markets are reacting to currency fluctuations and debt concerns. These developments suggest a gradual shift toward stronger gold integration within financial reserves. At the same time, financial markets show contradictions. Some stock markets rise strongly even when economic data appears weak. Governments may report positive growth numbers, yet real purchasing power measured in gold terms may decline. This difference between nominal performance and real value is important to understand. When you measure assets in dollar terms, prices may look stable or rising. But when measured in gold terms, the same assets sometimes show different trends. This comparison reveals deeper shifts in monetary strength and asset valuation. If gold continues gaining recognition as a reserve asset, its influence on global finance will expand further. More institutions may adopt gold-backed structures. More investors may treat gold as portfolio protection against currency risk. These developments reinforce the idea that gold is not disappearing from the financial system. Instead, it is being repositioned with modern technology and renewed institutional demand. The transformation is gradual, but its impact could be significant over the long term. As we look at the bigger picture, it becomes clear that gold is playing a stronger role in global finance than many people expect. Central banks are increasing their gold reserves. Digital platforms are exploring gold tokenization, and investors are using gold as protection against currency risk and debt pressure. All of these trends suggest that gold is becoming more important in the modern financial system instead of less important. If the shift continues, gold may act as a primary reserve asset supporting currencies indirectly. That does not mean currencies will immediately become redeemable in gold like in the past, but it does mean that gold backing can strengthen confidence in national financial systems. When central banks hold more gold and reduce reliance on certain foreign currencies, global monetary balance begins to adjust. At the same time, rising debt levels and budget deficits create pressure on governments. When debt grows faster than economic output, investors demand higher interest rates to compensate for risk. Higher interest rates increase borrowing costs and can slow economic growth. This cycle often pushes policymakers toward monetary expansion, which can weaken currency value over time. In such an environment, gold acts as a stabilizing asset. It does not depend on government promises or banking systems. Its value comes from scarcity, global acceptance, and historical trust. That is why many institutions view gold as long-term financial insurance. The growth of gold tokenization also reflects changing technology. Digital systems now make it easier to represent ownership of physical assets online. Instead of holding gold bars directly, investors can hold digital tokens that represent verified gold stored in secure vaults. This improves liquidity and accessibility while keeping real metal backing in place. However, investors should understand that tokenized gold businesses operate with thin margins because they must purchase and store real gold before issuing tokens. Their success depends on trust, transparency, and efficient operations. It is not a shortcut to unlimited profits, but it can become an important financial product in the evolving market. When comparing gold with other digital assets, it is important to focus on stability and function. Some digital currencies are designed for fast transactions. Others are designed for speculation. Gold, whether physical or tokenized, serves primarily as a store of value and reserve protection. Its purpose is different from short-term payment systems. In everyday life, people continue using currencies for transactions because they are practical. But for long-term savings, many choose assets that preserve purchasing power. Over decades, gold has shown resilience during inflation, wars, financial crises, and currency changes. If the dollar weakens because global reserves shift toward gold, asset prices measured in dollars may rise. But that rise may reflect currency depreciation rather than real growth. Investors who understand this difference can better interpret market movements. Looking ahead, the global financial structure may experience more volatility. Currency fluctuations, interest rate changes, and geopolitical tensions can create uncertainty. During these periods, demand for gold typically increases because it provides stability. For investors who want to position themselves strategically, monitoring central bank purchases, gold demand trends, and currency movements is essential. These signals help identify whether the gold-backed shift is accelerating or slowing down. The broader message is clear. Gold is not disappearing from the financial system. It is being repositioned with modern technology and institutional support. Whether through physical holdings or digital tokenization, gold is re-entering mainstream financial conversations. If you want deep analysis and clear explanations about gold, silver, currency trends, and market structure, stay connected with Gold Silver Scope for consistent updates and strong research-based insights.